Good morning, everyone, and welcome to another episode of Capital and Context with myself, Mark Insley, and Samuel Hallett.
Good morning.
Good. Lots going on as ever. I think again we'll just have a bit of a global theme to this one. We won't tap in too much to academics. I know we've got some good episodes sort of on that space there really. So firstly, how's your week been?
It's been. Do you know what? It's been a great week for looking at what's coming up in September, but we'll go over that more in a second, no doubt.
Yeah, and performance-wise, I was looking at the numbers this morning, all again hitting close to double digits.
Happy with the trajectory of the portfolios for the year. Particularly happy with our active fund picks. I think we've been really good on that this year again. That's something that we've been good at now for a good few years. I think working out sectors this second half of this year is going to be the tricky part. But we'll go over that in more detail in future episodes.
Sure. Coming kind of more back to sort of what's going on at the minute. I know you wanted to open with Walsh goes to Wyoming as your lead theme. So please expand further on that.
Yeah, so tail end. So next month we have the Jackson Hole committee. It's not committee, sorry, it's more of conference. So going there, we have 120 attendees from 70 countries. The official theme there is going to be financial innovation, implications for payments and policy. But that's not what everyone who's in the markets actually cares about. They actually care about one thing only, and that is the fact on the Friday, 28th, of August, I had it wrong, not September, Friday 28th of August, we have the keynote being delivered by Walsh. So, the Fed governor delivering this first big speech outside of the, Fed minutes, not that he does the press conferences now anyway. And so it's 19 days before the next Fed meeting. So it's basically going to be our one kind of bam, okay, where's he thinking? Bear in mind, he's being very kind of hesitant to give out any kind of messaging, etc. So there's going to be a lot of scrutiny on this.
A platform like that is just like a bit different. He's not like in his kind of quite so formal environment, and obviously still speaking to a set of speakers, but you think more insight might get gathered from that than other platforms.
I think there's also the level of scrutiny that goes into it is a lot more. So moves based off of what goes on at Jackson Hole can be really quite big from a Fed keynote speech. So I've got just here. So when Powell spoke in 2022, S&P moved 3% in a day, over 3% a day. Last year, when Powell spoke, small caps moved around 4% up in a single session. That 20 to 40 minutes can really define the second half of this year. So it's really, really important to look at that. But
sounds
I think
like one of your favourite option spread trades from your youth.
If only I was carrying on doing that, but then
personal
I'd be
trades,
distracted.
Personal trades can't be disclosed on this platform.
Not even as a student. It is one of those more interesting days, certainly in the year. And I think what's kind of interesting is Walsh has been very much going with this narrative as being quite a hawkish kind of leader and that kind of aspect. But I'm not sure the data's really supporting it, even though the number of dissenters against a hold, so people voting for a hike, has been going up one by one over the last three meetings. So last meeting there was 9 for hold, 3 for a rise. We have tomorrow something quite interesting. So alongside the UK CPI print, we have the minutes from the last Fed meeting getting published. So it'd be really interesting to see the narrative about how close were those other 9 to a hike versus actually the data doesn't support it. If I'm honest, at the moment, if you're looking at the data, admittedly I'm talking year-on-year figures rather than the last 4 or 5 months of month-on-month, because let's be honest, there's been a little bit of regime change. But CPI isn't like shooting to the moon. It's kind of within a range of target that isn't uncomfortable, I don't see necessarily reasons for a hike so long as one thing happens. If Iran, there's some kind of resolution before October. And the reason I say that is because one thing that's been backstopping the oil markets for the last 5 months, been losing track as to how long Iran's been going on for, has been the strategic reserve flows out, helping to add extra supply to the market. Now, although they were meant to have a fixed life, they're still going on because basically they haven't managed to pump out, what they said they were going to pump out in that time. It's going to take till October for them to do all of that pumping out.
Okay.
So that could be when the oil backstop gets removed, and then that creates a different picture. But as I said, last week US CPI and PPI and core CPI figures came out. Core CPI was 0.2% month on month. Analyze that out, 2.4. Nothing to be alarming. PPI output is still okay. PPI input, so what basically CPI that factories have to pay on the way in, that is looking a little bit pricey. So if that starts to translate into the PPI output figures, then that's definitely the point I think that I'd be a bit more concerned. But at the moment, I think that this hawkish narrative that's been going on especially the UK, isn't warranted. UK, I don't get it. I think we will hold all year. And you think at one point we were talking about 2 hikes. Yeah. I don't see it.
Yeah. US dollar, how will US dollar maybe be affected this week then? Fits and starts. How when that comes such a big factor, do you think it's an interesting week for the dollar or not so much?
US dollar or cable?
I guess the dollar in general.
So
obviously we'll always bring it back to what happens.
Yeah, of course. We have UK orientated investors, but of course the dollar really impacts what happens with emerging markets. So it's quite important to note for our viewers.
I just thought more from that rate hiking
exactly.
And things.
Exactly. It's going to. I think the big one is in those meeting minutes tomorrow. If it looks like those 9 were closer to a hike than holding, then you will see a leg up on dollar, and the 2-year treasury would definitely sell off.
Yeah.
But at the moment, I think it looks like pretty good value actually. The 3-year especially. Okay. Yeah.
And you touched on it there, but UK inflation, as you say, is a kind of week of inflation data. What's your thoughts on the UK? Where do you see that print and any effect this week on gilt markets?
So, I did a bit of back of a piece of paper calculation before jumping onto this podcast, which is, as things are, they are staying in line with Bank of England expectations. And that's the key thing at the moment. So at the moment, the Bank of England are expecting inflation to peak in Q4 at 3.2%. If that looks like it's going to maintain, we probably won't end up with a hike. If it looks like it's going to tick up at all, if that inflation starts kicking in early, then I think we might see a hike. But in the UK, it's a delicate situation. Before we went on air, the employment figures came out, notched up another little bit again. Job vacancies are at a well over 5-year low. So, I think, don't get me wrong, the Bank of England doesn't have a dual mandate, unlike the US. It doesn't care about what jobs are doing. But you say that there isn't, the headroom to give hikes that there is in the US. The one place I would say hikes probably are going to be happening more so, and they've started already, is at the ECB. That was kind of expected anyway to be starting hiking even before Iran. So looking at the figures this morning, that official figure comes out in a day or two. But it being Eurozone, obviously, you can take all of the members' CPIs and work out what's going to happen for the ECB figure. further hikes set for the ECB.
Yeah. Okay. And you sort of touched on the ongoing around. I don't want to go too deep into it, but
everyone's born of it.
Yeah, but we touch on oil, but like what sort of some scenario? I know you love the scenario driven stuff at the minute. So, and will you take any position to oil and where different scenarios might lead us?
There's a reason why I love the scenario
oil
stuff.
Did move about 5, like it can still go 5-6% in a day, right? It's not that
it is
volatility and oil's gone all quiet again. You can still
it is there. It just, the thing from our perspective is it's too short of a move that by the time we've waited for instruments to settle, it would probably already be the time that we want to come out, and it's that it just, I'm not sure it would work in an MPS.
Yeah.
Setting myself up there for a future episode. So how instead is moving to, got it lined up, it just needs to be executed at the right timing. We'd be replacing the gold positioning, which is perhaps another bullet point for this podcast. But moving to an active, in the P range, an active natural resources fund that can play that kind of game an awful lot better, a lot quicker.
Way to get exposure. Yeah.
So I think that's possibly more how we're going to do it. But there's a reason why I like scenario planning, because it's my job.
I understood. So what is the base case on oil? Really driven on ceasefire? Is that still, or is there other supply? Could there still be a ceasefire, but other supply things be a bigger factor, or is it a bit, like lots of things? Is it a mixture of different things? And I mean, where are we today on?
So
oil still
I don't think oil 2026 is the interesting question. I think it's oil 2027.
Okay.
And the reason why I say that is actually coming out of, let's call it around Mark 1, everyone's talking about an oil supply glut in 2027, as in that oil could end up crashing in 2027 because all of these rigs have come online to, in the same way that it takes time to restart rigs, it also takes time to stop rigs. So I think that the 2027 conversation could be quite interesting. It depending how, if the Iran conflict, kind of winds down in an orderly fashion, could actually end up with a really disinflationary environment for a year afterwards. Could be really interesting. The thing I think is more interesting in oil is on things like aluminium. Those smelters do not restart quick. You can imagine, once you turn them off, all of that molten aluminium hardens, so restarting them is not easy. And things like, obviously, the ammonia and things like that for fertilizer, so crop harvests next year expect to be very expensive indeed if we don't end up with a complete drought again, and what happens to crop prices there. So I don't necessarily think oil is the conversation coming up. I don't think it's the sexy thing. I think there's other parts that are more interesting.
Okay. I mean, that touches slightly on September positioning, but anything else sort of just on your mind before we close this episode?
Been looking at an awful lot lately at mortgage-backed securities. Okay. And that kind of part of the market.
Is that specific funds or funds that might choose to get a bit of exposure to them?
At this point, I'm not going to name a specific fund. The FCA would probably kill me if I did. I just think that, say, the mortgage-backed security bit in the States is quite interesting at the moment. There's quite a bit of spread over treasuries. That spread would have to widen a further 30 basis points for it to underperform treasuries over the next 5 years. So that I quite like.
What type of fund gets that though? I know you don't want to put names. Is it more like a strategic bond fund?
There's
a standard bond fund. I don't think would.
No, there's standalone mortgage-backed security funds.
Okay, so it's not even a strategic fund. It's a
standalone straight line
labelled up.
Yeah,
as that UK listed.
Yep, OIC. Yeah. I think it's an OIC, but it's certainly accessible for us. The thing though that one thing I will point out for podcast, and then I'm done for the week, is actually one thing I've been observing, which we wondered if it would happen, and it has been. So obviously we've now got all of these hyperscalers that are issuing a shed load of debt into the marketplace. You can see on the spread now on the AAA and AA, that spread is now widening up, and it's not the whole credit space selling off. It's that very much that investment grade bit is opening up, just because there's now so much supply going into the market. So be interesting to see how long that goes on for before the high yields kind of starts to sell off on a relative valuation basis. But yeah, you probably find at the moment high yield is in some ways better value than investment grade in the US for that reason, from a supply element.
Okay, well, please let us know if that is an entry you proceed with. Not that we hold you to these snippets, but it's good to know. Where these ideas do materialise into an actual position. So big week, as I say, recap on that, back to Jackson Hole and potentially interpretive news drivers in the market, inflation indicators across the world. Good busy week for you and the team. But thanks as ever for taking the time out for the podcast. Getting some continued sort of feedback, different audiences I know are tapping in. So thank you to those that continue to watch, and that wraps up another episode. Thank you, Sam.
Thank you.